Market expectations for early cuts in interest rates, well, they've received one setback after another since the new year. Central bankers in the US, the UK, Eurozone and elsewhere have consistently pushed back on market expectations for early cuts in their official rates. And this became even more specific last week with comments from the head of the US Central Bank after their rate-setting committee meeting that a cut in March was, quote, not the base case. And this was swiftly followed by super strong data on the US labour market, which seemed to seal the fate of early cuts in the US. And the result has been a sharp rise in interest rate expectations. And this is especially evident and especially relevant here in the UK, where 2- and 5-year swap rates, which drive mortgage rates and lots of other interest rates, they've risen by 50 and 40 basis points respectively since their lows just before Christmas. Now, to be fair, as you can see from the chart, they had fallen by much larger amounts since the peak last July, and there was a bit of a tumble towards the end of the year. Nonetheless, some lenders who introduced low mortgage rate deals early in the new year, well, they're likely to consider withdrawing them, while deposit takers, they'll be looking to improve the rates on their fixed rate bonds to remain competitive. But what does all this mean for the longer term outlook for interest rates and financial markets more generally? Now, it still seems to me that we're in for big rate cuts in the developed world. But I must accept that that outlook is clouded by more economic uncertainty, and in the case of the all-important US Federal Reserve, politics has come into play in a rather ugly fashion. Donald Trump has been fiercely critical, once again, of the chair of the Federal Reserve, Jay Powell, and accused him just a few days ago of planning to cut interest rates to get Biden re-elected. Now, Jay Powell has taken the unusual step, possibly in response, of going on US national television to set out his plan for cutting interest rates, and repeated that a cut in March was possible, but not the base case. He also said they were focusing on the year-on-year inflation rate, rather than the 6-month annualized rate that they had been previously emphasizing. That's already at 2%. But I think it's a good move, because some prices like used cars and car rentals, they've fallen heavily by 20% or more over relatively short periods. And those falls are not going to be repeated on that scale. Yet if you annualize them over a 6-month basis, you risk double counting. The good news is that the year-over-year measure for inflation should continue to fall over the next few months, and that's helped in large part by favourable base effects. What that means is that significant price rises at the start of last year, 2023, they will drop out of the year-over-year comparison over the next couple of months in particular. And with slowing wage inflation, not the numbers released on Friday, but the ones released a few days earlier, they're the better measure, they should allow the Fed to declare victory with a sustained move to their 2% target and cut interest rates heavily over the next year or so. Over here, on the other side of the Atlantic, there is less political pressure, but much more economic uncertainty. Madame Lagarde said last week in her elegant way that she was not date-dependent, but data-dependent, and that it was premature to discuss rate cuts. Now, the European Central Bank need to see a big slowdown in wage inflation in the wage round that's currently underway, and continued progress on price inflation if they are to cut in April. That's still a possibility, but a lot needs to happen, and with no meeting in May, June is the next bet. The Bank of England, they're even more firmly in the wait-and-see camp. They know that a 10% hike in the minimum wage is coming, and they understand, because they read the newspapers like the rest of us, that the government are considering a giveaway budget in March. They too need to see a big fall in UK wage inflation, and I think they could be one of the last major central banks to cut rates. Nonetheless, we are getting falling inflation, we are going to get falling interest rates, and that's good news for financial markets. Problem is, there is so much priced in. And central bankers, well, they tend to be cautious beasts. So, until next week, it's goodbye from me.